Welcome to today's webinar. Thank you so much for joining. So this is going to be a recorded session. I would encourage you to ask questions in the live chat. And today we're going to be discussing valuations for ROBS 401k business financing plans. And so please also like this video and subscribe. Let's connect on YouTube and as we do these types of videos every week. So let's get started. So just to put it in context, there's different situations when a valuation might be needed for somebody who has funded their business with a 401k business financing plan, what's called a rollover as business startup. It may be needed initially, and we'll discuss that here as we go through the slides. And then it's always going to be needed every year as part of the annual 401k compliance process. It's needed in connection with the annual filing. And then it also may be needed in certain one-time situations, like an additional investment, stock buyback, and distribution. So we'll discuss those scenarios as well. So that's the roadmap of what we're going through today. So let's first start out by discussing who can prepare the valuation. So there is flexibility in terms of who can prepare it, and that also means you want to consider the context. In other words, it doesn't need to be necessarily prepared by a valuation provider with a certain type of certification. There is a lot of good guidance that should be considered. So for example, there's IRS Revenue Ruling 5960. And you generally, of course, want to use a third-party provider that has experience and expertise in valuing businesses generally in your type of business. A lot of times it can be provided by maybe like your business CPA or tax advisor who's already, he or she is already going to be familiar with your business, of course. Looking at the additional regulatory guidance from the IRS when it comes to valuations, especially in the context of annual valuations, where you're doing the valuation every year, it's good to look at the flow of those valuations and also how the business is performing. In other words, if there has been changes in earnings, or let's say there's been a recent sale of company stock, and you have that type of change, if the valuation itself is not changing though, that could draw questions, right? Like, why is your earnings changing, but your valuation's not changing? Why was the stock valued for purposes of a recent sale? Why is that value different than the valuation you're using on an annual basis? And then just generally speaking, per the guidance, the valuation should be prepared in a systematic and a consistent fashion. So in other words, don't necessarily totally change up the methodology of how you use or determine the value from one year to the next, unless you can perhaps justify it because there's maybe some underlying business change, right? So you do have that flexibility, but you also want to be considerate in this context and take a methodical approach. Now, just to also highlight, that's one of the services that we provide is valuation services. So we facilitate those valuations, and we're going to touch on that at the end of the presentation as well, just to give you some more information. So please, again, don't hesitate to ask questions as we go through this. So now let's dig a little deeper in terms of the initial valuation. So when we say initial valuation, we're talking about someone who's using their retirement money to fund their own business. And so if that individual wants to use their retirement money to fund a business that they already own and operate, as opposed to using their retirement money to start a new business or to buy a business from somebody else. So if they're injecting additional funds for their existing business, that's where that valuation is going to be important. And the reason for that is in order to satisfy the 401k business financing rules. So under those 401k business financing rules, the way that you're able to invest the money in the business is you're actually buying stock in your existing business. So you're buying what they call qualified employer securities under the rules. And that stock that's issued to your 401k needs to be issued for adequate consideration. So what that means in practical terms is that in exchange for investing the stock in your business, the 401k is going to, I'm sorry, in exchange for investing retirement money in your business, the 401k is going to receive stock. So the stock is the consideration. So the question is whether it's adequate. And so in order to demonstrate that it's enough, that it's adequate, the price per share has to be a fair market value price per share. So let me give you a simple example just to kind of illustrate that. So, let's say that you are the sole owner of a business. And so now you want to invest through the 401k business financing plan, say $100,000 into your existing business. So if your existing business today, prior to that investment, has a $200,000 valuation, after you invest another $100,000 into the business, your 401k needs to receive 1/3 of the shares. So the percentage or the amount of stock that's issued to the 401k is of course a function of how much retirement money is invested, the 100,000, but also what that pre-existing value of the business is, 200,000 in this simple example. And so you can't just pick that $200,000 number out of the air. You need to have a valuation to be able to demonstrate that really is the fair market value of your business. And so that therefore the 401k really did receive adequate consideration. It received enough stock and therefore satisfied the 401k business financing requirements and the rules. So let me know if there's any questions on that. If not, we'll keep going forward. Okay, so another context where the valuation is going to come up is going to be in the reporting, in the annual filing requirement. So this 401k business financing plan results in your business having a 401k. So whatever business you have to run it as a corporation. That corporation is going to sponsor a 401k. So having a 401k is not just a one-time event. It needs to be maintained. And as part of that maintenance, there is an annual filing requirement. The filing requirement is called a Form 5500. So that 5500 is really an informational return. It's filed electronically with the Department of Labor, and it's got certain information about the plan that's listed on that Form 5500. It's sort of like a snapshot. So one of the important pieces of information that's on that 5500 is the value of the plan assets. And there's actually a specific line item if inside your 401k you have company stock. So the value of the company stock needs to be specifically listed on the 5500. So in order to determine the value of the company's stock, you really need to know the value of the company, right? So if you own 50%, or in the other example, a third of the business through the 401k, right? Then you first need to determine, okay, what's the value of the business as of the end of the plan year, reporting date for the 5500, and then from that value, we therefore can derive the value of the stock. And it's important to note that the 5500 itself is an audit tool. So, that's part of the reason that it's so important to file that 5500, and you really want to make sure that the information that's listed and reported on the 5500 is correct. So that's where the annual valuation requirement comes into play. Now let's talk about one-time valuations. So these are situations that may not apply, right, every year, like the 5500, which always applies every year. but it could come up periodically in the course or in the life of your business, right? So if you are making an additional investment, well, that additional investment, whether it's retirement money or non-retirement money, needs to be structured as a subsequent stock purchase. So that means that the company is issuing more shares, either to you personally or to the 401k, depending on whether you're investing retirement money or non-retirement money. So when the company is issuing new shares, it needs to issue those new shares for fair market value at the time of that subsequent investment. So it's just like when you make that initial investment, it has to be issued for fair market value. So again, you can't just pick the value. You need to have a third-party valuation to be able to demonstrate, okay, well, this was a true fair market value. So for example, I mean, even if you're investing non-retirement money, that's going to dilute your 401k's ownership percentage. And that's okay if it's being diluted at a fair market value, because now essentially the 401k owns, even though it's a relatively smaller piece percentage-wise, the pie or the overall value of the business is bigger, so, or larger, so that's acceptable. So that's essentially an even, the 401k is not being unfairly diluted, in other words. Stock buyback would be another scenario where evaluation would be needed. So here, when we talk about stock buyback, what we are referring to is the fact that the corporation is buying shares back from the 401k. So that's the reverse of how you initially funded the business, right? Initially, you might be rolling over money from, say, your former employer plan or maybe a non-Roth IRA into your new 401k, and then you're investing that money into the business in exchange for stock in the business. So stock is issued back to your 401k. In the future, as the company makes money and has after-tax profits, it may choose to buy some of those shares back from the 401k. So that is the reverse. So now the company is sending money back to your 401k, in exchange buying back some of those shares. So when the company buys back those shares, it needs to buy those shares back for fair market value at the time of the buyback. And that's again where you would use that valuation to determine, okay, what's the price per share at that time? So now another example, the third example here on the slide is a distribution. So to come up in the context of a required minimum distribution, or if you just elect to take a taxable in-kind distribution of shares. So this would be where, I mean, maybe it's easier to understand in the context of a required minimum distribution. So, once you get to the RMD age, then 72, which is under the new, the recently passed legislation in the Secure Act last year, you need to take money, or if you don't have money, assets out of your retirement account. So if there is really not enough cash in your ROBS 401k account to satisfy the required minimum distribution, then you're going to have to take stock out of the 401k. So we're talking about stock in your own business. So the stock is transferred in kind from the 401k to your personal account. So in that situation, you need to pay taxes on the value of that stock. So again, there you need to know the value, and so that's where evaluation is going to come into play. Evaluation is going to demonstrate, okay, what's the value of that stock? Therefore, how much income do I have to report? Because now you've got to report that income to the IRS and pay the taxes associated with it. Again, please don't hesitate to ask questions. Thanks everyone for continuing to listen. We're almost done here. We're going through, now we're going to talk about the valuation services that we provide. So as part of our services, of course, obviously all of our 401k business financing customers need valuations. So we facilitate that valuation through our, as part of our services. It is included for new clients, the cost of that is part of our annual fee. For an additional $4.95 fee, we can also do it either for other businesses or if you need that one-time valuation. The valuation that is going to include an industry report, so it's got a lot of good information about the industry that you're in that you may find useful. And it's just good to note that the valuation service that we provide is the same service that is being used by major banks and financial institutions like the ones listed here, just as a couple of quick examples. So it's definitely a reputable service that you have access to. So that brings us to the end of the presentation. Let me know if you have any questions. Otherwise, again, I really appreciate everyone taking the time to listen. And please connect with me on YouTube and look out for future announcements of webinars. Have a great day, everyone.